How's it going today, guys? So today we're going to be talking about bonds, and I don't know if you ever got these as a kid. I know when I was a kid I would get them for my birthday from my grandparents, and I didn't understand what they were because I would see on there they said $100 on the front of them, and I was like, well, this is awesome, I got $100. Then my parents would explain to me, no, really, it's actually worth, $50 now. If you hold on to them, they'll be worth the full $100. So they always confused me for that reason as a kid, because I was like, well, it says $100, you would think it would be worth that. But I want to explain to you how bonds actually work and a little bit about those. This is basically everything you wanted to know about bonds, but you were afraid to ask. I'll put it that way. So basically, a bond is considered a debt investment. Money is loaned to an entity for a period of time. It's a fixed period of time, so they let you know beforehand when you buy the bond how many years until your maturity date. And it generally has a fixed interest rate, however some have a variable interest rate. Bonds are considered a much safer investment as opposed to buying a company stock or any kind of mutual fund because of those two reasons, because they're a fixed interest rate usually for a designated period of time, but they're generally a lot lower interest rates than you could see from a mutual fund or a stock. So that's why they're kind of a very overly safe investment. Just as a side note here, if you have a 401k and it's one of those vision plans where it plans out for you a retirement date, when you start off, like for example, I have one. I know right now the majority of my money is being invested in stocks. And over time, I think in 5-year increments, it's gradually buying more bonds because they're a safer investment. So when you're younger, you want more high-risk investments. You want more of your money in stocks. And when you get older, you want more of your money in bonds, even though it's commanding a lower interest rate than you're going to get with a stock. Simply because it's a safer investment, and you want to have that security at that point in your life because you're going to be retiring sooner. Whereas for me, if the stock market, crashed on me or something happened to the stocks that I was involved in with my retirement plan, I would have many years to recover from that. So by entity, they're generally, they're only issued by companies, municipalities, states, and governments. Bonds usually fund projects, especially with companies. They'll do a bond for a project. Some municipalities do bonds as well for projects. And they can be another option for a company aside from going to a bank for a loan. So it may be something they decide to do for whatever reason, is issue bonds to fund a certain project. They're typically issued at $100 or $1,000 per bond. And then here's a couple of terms that you should be familiar with if you're reading about bonds, so you understand what it is that they're telling you there. The face value of a bond is the dollar amount the bond will be worth at maturity. So like I said, when I first got bonds as a kid, I saw the $100 on there and I was like, well, this is great. I got $100 from my grandfather. That was the face value of the bond. That's what it would be worth if I let it sit for the duration of time for it to grow to that $100. The coupon rate is the interest rate the issuer pays on the bond. So certain bonds, they pay you at designated intervals, whether it's twice a year, 4 times a year, once a quarter, they pay you a coupon rate. And that's the interest rate. So if it's a fixed interest rate, it pays you quarterly, almost like a dividend, or maybe once a year on that bond. The bonds I was involved in were U.S. Treasury bonds, so they didn't pay out like that. But some company bonds and other ones do pay on those like that. And then your coupon dates are basically the dates the bond issuer makes the payments. Like I said, usually it's at most once a quarter, maybe twice a year, or once a year they'll pay on those if it's that type of bond. Your maturity date is the date the bond is worth the face value. And then the issue price is the original bond price. That's like what the person purchased the bond for. And like, let's say those bonds, those treasury bonds I got for my birthday, I believe you paid $50 for them, and then I think it was 10 plus years they were worth $100. Had I gone to the bank with that or wherever and tried to cash it in the day after my birthday, they would have given me $50 back because it had no time to mature. And when I did end up cashing those in, I think I cashed them in before they were worth their full face value anyway. So I think I got about $70, $80 a bond. But, it was kind of cool. It was an interesting way to save money, and it kind of taught me a few lessons as a kid getting those bonds, so it was kind of an interesting thing to do. I think it's kind of going out of style though. I don't know a lot of parents who are doing the savings bonds anymore. So this is basically who issues these bonds. So if there's a corporate bond that's being issued by a company, generally it's financing a specific project. Municipal bonds are issued by states or local municipalities. That could also be something to fund a local project. And then U.S. Treasury bonds, those were the bonds that I was involved with when I was younger. These are the bonds that most people are typically seeing if you have some sitting around your house, or maybe you have like a box that you have all of your paperwork in, you're thumbing through it, you find a bunch of bonds and things that have a $100 symbol on there. Those are generally U.S. Treasury bonds, and those are issued by the federal government. Let's see, next I wanted to just mention, as far as interest rate goes with a bond, the interest rate of a bond is determined by two factors: quality of the credit, as well as the duration of the bond. Generally speaking, a longer duration bond is considered higher risk. So if you have a slower quality credit with a longer duration, that's going to command a higher interest rate from the market. And if you have a shorter duration bond with a good quality credit for the person that's borrowing the money, it's going to be a lower interest rate bond. That's why the federal bonds, or the U.S. Treasury bonds, are so low in interest, because they're a very safe investment. They're probably as safe as you could possibly get. That's why I don't invest in bonds anymore. Other than I know I have some in my 401k, but they're just sleepers for the most part. It's like not a lot of money that you're getting back in interest. And then just to explain three other things with bonds. Zero coupon bonds do not pay out those regular coupon payments. Like we said here, some bonds that pay, a certain amount of money every quarter, twice a year, once a year. Zero coupon bonds do not do that. Convertible bonds allow bondholders to convert debt into stock if they wish to at some point. So if at some point the company is doing very well, they can convert their bonds into stock. And then bullet bonds are the most common. Those are where the entire face value is paid upon maturity. There are no coupon payments. So, for example, U.S. Treasury bonds are a bullet bond, because you're not going to be getting the money from them until maturity, or whenever you sell the bond. You're not getting a regular coupon payment on those. Well, that's pretty much it, guys. That's like the basics of bonds. Now, it does get a lot more confusing, so if you do want to dive deeper into this, I encourage you to do your own research. But I looked at a couple of websites that talked about bonds, and I tried to grab like the best information. So this is like the bare bones information as far as bonds go. And like I said, I don't personally invest in bonds other than what's in my 401k. I personally trade individual stocks. It's just something that I like having more control over my investments. I do have a mutual fund too, but I kind of like trading individual stocks, and it's something I've been doing over the last couple of months. So if you guys are at all interested in my personal trading strategy, I'll link up in the description. I have my my guide to my investment strategy in the stock market, and I've actually had pretty good luck trading in the stock market. I make a couple $100 pretty consistently every week trading stocks. But that's pretty much all I got for the video on bonds. I thank you guys for watching.